Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. This could be a 3-hour conversation. We've got precious minutes this morning with Rebecca Patterson, a tour of duty with Bridgewater, sound trust advice at Bessemer Capital, and we're thrilled that she could join us. Bessemer Trust, I should say, and we're thrilled that she could join us. Paul, we're going to ignore the Patterson paragraph on Bitcoin.
Okay,
We're just going to ignore it because there's too many other things going on right now. I want to go back to JPMorgan, where you understood dollar yen versus Korean won and the rest of it. The carry trade, JPMorgan publishes this morning, you know what, it's mostly done. I've got my own theory. What's the Patterson theory on when this agony's over?
Well, I think you actually do need to listen a lot to the big investment banks that have large FX trading operations right now. JPMorgan's obviously one of them, because they're going to have the best real-time data on where investors are versus where they were and what might seem comfortable in the new environment we're in. So you've seen JPMorgan say maybe we're almost done. A few other banks I've read in the last 24 hours say we're not done, but we're closer to the end than the beginning.
Okay, what you do in the summer and in August at the Patterson household and the Keene household, when the brats are up, you slap them and say, shut up and watch a real movie. You can't watch Glee 5 times. So you're watching Butch Cassidy. Who are these guys? Who are the people in the carry trade? Is it dreaded hedge funds at Hudson Yards?
So just for the record, I've never slapped anyone. I know you're joking. Feel like I need to get that out there. I think we don't know yet who exactly has been in the carry trade, but I would certainly assume that hedge funds have played a role. But one piece of the market that I think we need to pay more attention to is the retail investor. If you look at data from the Federal Reserve, the total market, the percent that's retail today, is the highest it's been since, get ready for my dates, 07 and 99. Now, that doesn't mean we're going to have the same ending to this movie, but it does mean that they're playing a significant role. And today, they have more tools, including zero-day options and levered ETFs. They have easier access with all these free to cheap platforms. So I wouldn't be shocked if there is a surprisingly large retail element to all of this.
What do you make of the last 4 or 5 days of trading? We had that jobs number last Friday that really seemed to spook the market a little bit. We had a lot of selling and instability in the marketplace the last several days. Maybe what do you make of kind of where the economy is and maybe what the Federal Reserve is thinking about?
Sure. So the poor manufacturing sentiment and the payrolls certainly came right together with the Bank of Japan decision, not just to raise rates, but give hawkish guidance. That plus positions, I think, all came together to trigger this sell-off. But when I take a step back and look at the economy, I think we're still kind of 50-50 if we get a soft landing or something bumpier. The service sector sentiment, and the service sector is a much bigger part of the economy. It's still holding up well, better than expected, still expanding. Yes, we're getting a lot of earnings suggesting consumer caution, but so far, most of those seem more focused on the lower end consumer, which we know has been stretched for some time. But I do think it makes the recovery more vulnerable. So if the expansion more vulnerable, if the wealthier consumer starts getting more cautious, or companies just say we need to start cutting some jobs or paring back investment, this thing can get a negative kind of flywheel going pretty quickly.
So what does our Federal Reserve do here come September?
Well, we have almost 50 basis points priced in for September. I do think it's likely we get a cut. The question is it 25 or 50? I think that will be a debate. We'll get guidance from Powell at Jackson Hole, as you mentioned earlier, and we have a lot of data. So it's going to be, I hate to say this because it sounds like a cop-out, but it is going to be data dependent in terms of the degree of the cut we get September.
I agree on the data dependency. Bruce Kasman out with a note this morning following up on a statement 10 days ago that he sees global disinflation. What I don't see in the zeitgeist right now, Rebecca, is a discussion of the dampening effect of disinflation and deflation on the optionality that institutions have. They're going to run out of choices here if we get Wei Li's 3% China GDP growth, if we get Kasman's global disinflation. How constrained are institutions going to be 6 months from now?
Yeah, I mean, we're already starting to see more companies feel the heat from not being able to raise prices as much.
Yeah, did you see Warner Brothers Discovery? That was heat yesterday.
Yeah, that was a little heat. Or the McDonald's $5 meals. You know, we're seeing companies realize consumers are saying no more, and so they're having to react to it. And if that continues, obviously, we're going to see it feeding through into profit margins.
What have you seen from earnings this period? How would you characterize it?
Yeah, I mean, I wouldn't say it's bad by any stretch, but I think what the market is latching onto is this sense of caution with the consumer. What struck me, though, is it's coming from China and the U.S. So there's two stories here. There's the soft China story and the cautious U.S. consumer story. And I wouldn't take my eyes off of China. Tom, you mentioned the Chinese renminbi earlier, you know, when we talk about carry unwinds. And China, you know, their bond yields have fallen so far. The government's now threatening to intervene to push up bond yields because they don't want a speculative bubble in bonds. The last thing they need is higher yields right now with their economy so soft.
Right.
So they're kind of stuck. And I think we need to keep watching how that flows through both to disinflation and growth.
I want to overlay here your experience with talking to people where short term is 3 years.
Yeah.
How do you prosecute an adult investment cycle or unknown future given the cacophony of short term idiocies?
What a great sentence. This is why I love coming on air. You know, it was beautiful.
I'm not awake. I stayed up and watched Siberia synchronized swimming, so I'm not awake.
Well, just like Christine Lagarde, I was a synchronized swimmer, so I'm all about that. Yes,
How
that's
do you
another
do it?
conversation.
Stop the show. Stop the show. Stop the show. Breaking news here. We got 3 minutes left.
No.
How in God's name do you put your feet up in the air like? I mean, I talked to Lagarde yesterday about this. What are you doing with your hands to get your feet that far up in the air?
Well, the technical term is sculling, but you're just moving your arms back and forth, almost like a little propeller. But let's get back to investors. Yes,
Would you do synchronized swimming in the Seine?
No, not in a million years.
Okay, get back to the
Okay, all right. So focus. You know, I've had the luxury of dealing with very short and very long-term investors, and I think for the longer-term investor today, you know, this is an opportunity to say, is there anything I've liked that I can now get 10 or 20% cheaper? And I think some investors are looking at Japan saying, you know, we're getting a lot of reform, corporate reform that's important. We are seeing some positive movement with actual earnings and buybacks from Japan. I'm a little more skeptical on Japan just because I think that their economy is still so dependent on the U.S. And if we have a bumpy landing in the U.S., it's going to be hard for the Japanese equity market to decouple. But overall, I think you want to stay, I know it's very obvious, but diversified. And geography is not enough. We saw this Friday and Monday. When the stuff hits the fan, correlations go to 1. Europe, Japan, they all sell off with the U.S., so that's not enough. You have to be thinking about your assets, sub-assets, the type of securities you own. I think that still includes treasuries and gold as part of those diversifiers, even today. And one place I would look at overseas right now, which I think has gotten a little bit ignored, is the UK. Very low beta equity market. Very good, attractive valuations. And I think we'll see, for the first time in a while, we have a grown-up government that might bring some stability. And stability would be a positive improvement. So that might be one to look at as far as a defensive equity position that you can get on sale right now.
But when you look at Europe and the UK, you don't have a big tech exposure there. So you're talking about stuff, they actually make stuff and they export it to China. So there's a China risk in those markets, right?
I think more so in Europe than in the UK. If we were talking about Germany, I'd say 110%. Right. I think the UK, the sectors in the UK equity market are a little different. And I would be focusing more, frankly, right now on the UK domestic equity market, so that index specifically.
Rebecca Patterson, thank you so much for joining us.
Great to see you guys.
This one, just a great brief there in this. Priya Misra with us with JPMorgan Asset Management, a portfolio manager. And I've just got to go to your arch call of lower yields over 24 months. It's Priya Misra, genius. Ian Lingen sat in that chair yesterday at BMO Capital Markets and said, out there we will power through 4%, well down into a 3%. And he frames out 2.95% somewhere out there distant. Do you have the same overlay, price up, yield lower, lower, lower?
I do. And here's why. I think the last week, if you didn't think that bonds and stocks were essentially negatively correlated, well, the last week shows you that they are. So, if we stay in a soft landing, the interest rates are going to fall because the Fed's going to have to cut to some normal level. We don't know what that normal is, but it's not 5.5%.
Right.
If it's 3% and the Fed's cutting all the way down to 2.5% to 3%, that 10 years is going to fall. If we actually slip into a recession, that's where risk assets are going to struggle, right. and that's when interest rates are going to fall much below that level.
Somebody said to me yesterday, they said, what's the single thing we're not talking about? And I quoted Bruce Kasman. He's an economist at a small bank down on Park Avenue. Bruce Kasman wrote a piece on global disinflation. And to me, that's the heart of the matter. Fold in the China-driven global disinflation into your portfolio management.
Absolutely. So I think inflation is extremely global. We saw that on the way up. It's going to happen on the way down. I would argue markets are extremely global. But we can sort of focus on, I think, one or two things at a time. So the last week has all been about the U.S. payroll report or dollar yen. But look at globally, where is the engine of growth? I think the engine of growth was in the US, and now there's a question there. Are we slowing to normalizing trend levels? Are we slowing below that? I think that's still an open question. But look elsewhere, and global growth is slowing and inflation is decelerating. So I think the market's focus, the Fed's focus has absolutely moved away from inflation. We have a CPI report, and I'm less worried about that next week than I am about initial claims, which is showing up pretty soon.
Coming up very soon. So what should our Federal Reserve be doing? I mean, Monday morning, we had discussions of an emergency intermeeting rate cut on Monday morning early. What do you think this Fed should do in September?
So, I think they should start normalizing. We're at 5.5. Inflation is decelerating, globally. It's decelerating in the US. Service inflation, wage inflation is all coming down. I think they should absolutely be cutting. Where I've struggled with is this idea of gradual normalization. We know monetary policy works with a lag. So if the labor market, which Chair Powell said is back to 2019 levels, if inflation is decelerating close to that 2%, they should absolutely be cutting. I think they should be cutting fast to normalish levels. So 50 basis points makes sense. The intermeeting, I think the market went a little too far.
Okay.
For an intermeeting rate cut, I think you need severe financial market stress, which is going to threaten the recovery. So at that point, we're talking about either an institutional failure or markets breaking down. I think the speed of the move was interesting, but it is August. There is summer liquidity. Everyone was in the soft landing trades. Yep. I don't think we should get carried away about intermeeting cuts, but I think the Fed really here should be normalizing. Perhaps they should have started last week, but they can catch up quickly.
They can catch up. So what happens when a Fed begins to cut? How do they do it? Do they do it like every meeting, every other meeting, 25 basis points, 50 basis points? I can't even remember the last time we were in a cutting cycle.
So I think people look at the last cutting cycle, which is COVID, and that's where this intermeeting cut comes in. Or they look at the one before that, and the Fed's cutting really fast. I think this could be a very different cutting cycle, and fairly similar to the hiking cycle. Remember, they started, they went aggressively 75, multiple 75s, and then they slowed down. I actually think this cutting cycle might look similar. Go 50s all the way to some level of neutral, maybe it's 3%, which is where the Fed is at. Then they can slow down, and that gives them the opportunity to respond if things slow down. I think, the 150 is not going to, the market's going to focus on that dot plot. We're going to get a revised dot plot in September. Is the Fed going to talk about aggressively getting to neutral, or are they going to stay on this gradual path? And that's when the market's going to get really nervous.
I don't want to get you in trouble with Stacey Friedman and General Counsel over at JPMorgan, but I got to ask, because I think all of Global Wall Street wants to know. You killed it as a strategist, and now you're a portfolio manager. What's been the biggest surprise about being, quote unquote, a portfolio manager?
It's the correlations, which as a strategist, I could look at Excel and, have a lot of conviction on correlations. And then you live days where the correlation goes from negative to positive across asset classes. Because interest rates was hard enough, trying to figure out interest rates and then how does that feed through across portfolios, or, does it have differential impacts in different parts of credit? That's sort of what I spent.
So where's the opportunity now in those differential impacts? That's the key question.
So I think
I'm asking for Jamie. He just emailed me.
So there is opportunity. I think high quality spread product, you're locking in yields of 5.5%, 6%. But here's where, when your end of cycle cost of capital is high, this is where that research background helps. You have to look at companies, you have to look at business models. What are companies doing with debt? I think dispersion is increasing within credit. So do the work, buy high quality spread product, and buy some duration.
30 seconds. Can you frame a sub 3% 10-year yield? Not the drama of back to negative rates, but can you see price up, yield down that much?
I can. I think we're normalizing if the Fed, in terms of the economy, as of the data right now, if the Fed doesn't cut quickly enough or the lags are long, they were long on the way up, they could be long on the way down. The economy slows into recession, the Fed's cutting to 2% or below. At that point, the 10-year is going to be the only thing that investors are going to want. That's when you're going much lower in yield.
Priya, thank you so much. Priya Misra is with JPMorgan. This is classic Belski, folks. He writes a mental note, paragraph to paragraph. You hate him because if it's a 6-page note, you got to read all 6 pages. He writes a blistering 2-paragraph, 3-paragraph note, which is what everybody calm down, figure out what you're going to buy when you have the courage to buy. Brian Belski, BMO Capital, joining us now. Brian, what will be the signal for you to take that list of equities you've got and pull the trigger and buy at the margin?
Well, good morning. The market seems to be this fire aim ready again, which for us creates great opportunity because we have a process and a discipline. The names that, we listed in our note this morning are all kind of core names. And because we don't do a lot of or invoke a lot of turnover in our portfolios that we manage for a great wealth management system in both the United States and Canada, our clients are already invested in those names. And if you take a look at where there's been blood in the streets, not like a Warner Brothers Discovery today, because obviously there's some operational issues there. But names like Morgan Stanley that were down, or the Apple pullback, or even Lululemon, when there's strong fundamentals underneath that, Tom, we want to own those names longer term. We've had an opportunity this week to kind of rebalance portfolios.
And what's important here, folks, is the adults look at the Bloomberg and they use fundamental technical and economic analysis. Paul, the weekly chart, not the daily gyrations, smooth it out a little, Paul. The weekly chart, take it logarithmic, Standard & Poor's 500, and Belski has this tattooed to his brain. We are perfectly back to the long-term bull market moving average using the exponential moving averages I use. We haven't even broken long-term support, and we're all going to cash.
We're all going crazy. Tom, about a million years ago, Brian was a student at St. Cloud State University, so I had to Google map this. Dude, it is practically in Canada. It is way up there in Minnesota.
It's good hockey.
And it's on exactly
hockey.
The Herb Brooks National Hockey Center's there, Tom. It's
Mr.
right
Brooks
on the Mississippi River.
Yeah.
I forgot the Mississippi River's all
I
the
played
way
with
up there.
animals from Edina, Minnesota.
Yeah.
And they were like basically junior A players from Canada masquerading as Americans.
Cow.
Continue with Brian.
All right, Brian. People were freaking out in Monday morning, Brian. There was a sense of panic in the market here. I mean, did you sense that? And what does that tell you about maybe how investors are thinking about this market?
We did, Paul. And, it's still the old notion, attention spans of gnats. And, oh, by the way, it's gotten worse. We seem to have forgotten that August is usually a very bad month. And we've had it in 2022 and 2023. But if you go back to the 90s, it was 5 straight years where August were negative. And it's really, especially this year, Paul, I think, too, because a lot of people are on vacation. And the adults are away, quote unquote. And I think that's what's caused, even this morning with the goofy move in the treasuries off of an employment report, which we are guessing, by the way, that the employment report is going to be restated and not as bad next month. So I think people are way too macro oriented. We've said it on your network before. We think this is like taking candy from a baby, meaning you want to be an investor, you want to buy good companies, you want to buy the dip. And it's the old notion of the Warren Buffett rule is that you buy when there's blood in the streets and there's lots of emotion. So we're actually excited about what's gone on because this is actually quite normal.
Quite normal. A lot of folks, Brian, has been saying, in a normal bull market, you do need to see some pullbacks here, 5, 10, 15, 20%. So maybe that's kind of what we saw a little bit here. How about some of these big tech stocks that historically have moved this market higher? They have been weak. There's been that rotation trade. What do you do with some of those big tech stocks here these days?
Well, we really continue to believe that from a thematic basis, those big tech stocks, we call them the Super 7, are really your consumer staple stocks now. And you keep core positions there, much like Warren Buffett did, by the way. He just sold a little Apple. He was way overweighted and he's owned the stock for 20 plus years. So I think there's been way too much negativity surrounding that. But then you start buying these other tech stocks like Palantir and Oracle and AMD and Qualcomm and Broadcom. But I think what people are missing is the broadening out effect of owning a little bit of everything. It means small mid-cap stocks. It means value stocks. It means financials. It means playing themes and being more fundamental.
Brian, I got one final question. It's all this tech love. I get it. I don't even know what Palantir is. What do you do with Walmart? I got a company with single-digit revenue growth popping a forward 27, 28 multiple as well. Is there finally now an opportunity with these slow revenue growers with these huge valuations? What do you do with Walmart?
We love Walmart. We own it in 3 or 4 portfolios. In the consumer staples space, our core names are Costco and Walmart. Who's not going to shop there? And especially considering if people are worried about stretching their dollar, they're going to go to Walmart and they're certainly going to go to Costco. And I think Walmart's done an amazing job on their web platform as well. I think it's a name that a lot of core people don't own the stock in core portfolios. So I think there's a real opportunity longer term there as well.
Lisa, do you want to drop in a question here on Costco to Mr. Belski here? I mean, she is our securities analyst on a $1.50 hot dog.
They are increasing their membership. But that's how they make most of their money. Is this where some of these retailers are going to go toward more the membership route? Is that going to attract more people in?
I think that might be part of it too, Lisa. You remember here in America's heartland of Minnesota, I mean, we sit and stand in line to get gas at Costco because we're very cost conscious. The American consumer is super smart, Lisa. If they have $100, they're going to spend it where they can get the most for $100. And so I think that we can't discount how strong and consistent the U.S. consumer is.
How do the Vikings look this year, Brian? We got to go, but I mean, is this finally where the Vikings get their act together?
Oh, we're all excited. We got training camp. We got a new quarterback, which means probably we're not going to do very well. So
very good, Brian. Brian Belski, thank you so much with your Vikings update from Minnesota. Your daily look at the front pages, the Lisa Mateo Hour. Tell me we're bumble-free on the newspaper.
We are bumble-free, but we're
God
not Costco-free. It's about Costco. I had to go and start there. Okay, they are cracking down on the membership sharing, kind of like Netflix is doing the same thing. The problem is that too many people are sharing it. They're going into, I don't know if either of you have been to a Costco,
no.
But when you go in, there's someone at the door who checks your ID. But the picture is really small. They can't see it. They just, wave you and just go in. I wipe my app and they just say, yeah, sure, go ahead.
So you're a member.
So I'm a member.
Yeah.
So what they're starting to do is they're having these ID scanners so that when you go in now, what's going to happen is that you scan it and it comes up on this bigger screen so they can actually see the picture and say, oh yeah, that's you.
Is that a thing? I mean, are people really doing that?
People are really doing that. They're just, all they're doing because they don't really look at
What's
it.
What's a Costco membership?
I have the higher version.
Of course you do.
Oh, I'm shocked.
Yeah.
That's about $130. The fees are going up in September.
Right.
And
is that
first
worth
time
it for
in
you?
7 years. For me, it's worth it because you get 1% back. So at the end of the year, I get a check that basically pays for that.
Is it
nice?
Is it the same as the magic it was like in Red 2 when Mary Louise Parker's in there? and John Malkovich is in there like an aisle 4 with the Kirkland toilet paper. And that is
toilet paper.
Is Costco the same as it was when Bruce Willis made that great movie?
I think, hey, the hot dog price is still the same.
The hot dog's not the same.
All right, very good.
But the Kirkland item is not as well. Next.
So yeah, they're cracking down on that. Okay, a new report shows the pandemic shifted U.S. jobs away from big cities into smaller metros. So I'm going to break this down for you. This is from the Federal Reserve Bank of New York analysis. Job listings, large central metro areas now count for about 38% of total listings nationwide. That's down from 46% pre-pandemic. And the portion of job openings in smaller metros, that increased. There's also a shift in the type of jobs. You have postings for jobs related to computers, math, that fell. And then job listings in healthcare, that rose. And they're saying, why? Well, what's the reason behind? Well, it's remote work. Okay, people are moving away from the big cities because they can work remotely from wherever. And as they start to relocate, then you have people who are needed for, let's say, food workers, healthcare, other services. So that's the reason.
Paul, you're more up to speed on this. I'm thunderstruck by how empty the streets of New York are at selected times. It's like embedded now. Can we say work from home?
I think so.
Is embedded?
I think it is.
Full disclosure, Paul and I think this is nuts, but
no, I think you're right, Tom. I think you're right. I think, and again, I just think about my own offspring. It's part of their. That's just how they view the workforce as a hybrid kind of environment. That's where we are.
Are they doing the hybrid? Or mostly?
Yes. Even like Fidelity. My son works at Fidelity. Hybrid. Okay. Universal Music Group, kind of hybrid.
It's un-American. Peter Lynch was never hybrid.
I tell you what is the defense contractors my son works for, not hybrid.
Is Bumble work from home?
Bumble's work from home. Okay, we've been talking about the river Seine, right? And if the water is safe, if it's not safe, as they get ready to start the swim, I think the women start today. So there's something going around that the swimmers are drinking a can of Coke. That is the secret to not getting sick after you get into the water. There's reasons behind this, okay? It's not proven, just want to put that out there. There's no medical evidence for this whatsoever, but they say they're fans of it. The reason is because the acidity works as this like quasi-bleach for your digestive tract. Nice. So you don't get sick that way. I mean, think of it. If you take a can of Coke and you pour it down your drain, it clears it out.
Is this, wait a minute. Is this plus for Atlanta or minus for Atlanta? Which is this?
Well, I mean, after a big night out, so many days I've said, there's nothing better in this world than Coca-Cola.
Really?
Oh my God. It just revives you like nothing else in the world.
But the athletes like it because of that sugar rush too, because it returns like those glycogen levels that they
and I've heard
now, do you have Coca-Cola in Mateo household?
Never, no.
I mean, again, reason number like 3,000. I'm never going into the Mateo household. No Coca-Cola.
Sorry. Too much sugar.
Lisa Mateo, thank you. Lisa Mateo with the newspapers today. Thank you so much.
Oh wait, there's one more time.
Oh, one more.
Excuse me. We have video to go with this.
Tie a bow on it. Next.
This one. Okay, we have the video. There were these dogs. There's video of the dogs in the house, and what happens is that make sure you keep vet bill and kennel fee away from your cell phone battery pack, okay? Because you see the dog, he's biting on it, he's chewing on it. If you're watching on YouTube, you can watch along with us, and all of a sudden, it starts to spark up. Oh, and he jumps off the bed, and it bursts into flames because he's on his pet bed. So the other dog runs for the hills, and now he's saying, "What are you, an idiot? What were you doing, dog?" So the two dogs and the cat scooch out the dog door. They're saved. No one's hurt. That's the main idea here of this story. But the lesson learned is these things can be kind of dangerous.
Well, it's serious. John Tucker's really led on this. I think John's done some great reporting on it. I'm sorry he's not here. He's looking at Siberian Olympic outtakes. But Paul, I'm sorry. For Mayor Adams in New York City, there's no more serious issue.
The FDNY, Tom, the FDNY will tell you this is a huge issue for them. It puts their firefighters at risk. And I learned this a long time ago with my oldest son, who was into all those battery packs for his various RV vehicles. And he would store them out in the garage. He would never bring them to home, put them in these special wraps and special containers because he was trying to explain how.
Right.
And sure enough.
Okay. I'm not good at this. Scary. Does a Vespa have a lithium battery?
No, it does not. We are gasoline powered, baby.
Okay, there we go. Safety on the Jersey shores.
Exactly.
Lisa Mateo, thank you so much for the newspapers. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.